you guys already know, and yet we've got a Fed that's about to cut rates. And they were even debating cutting at 50 basis points, but they're almost guaranteed the 25 basis points. So even though I don't agree with that, and we can debate that another day, we've got a government that's basically saying we're going to prop up the market no matter what takes place. There's a really good stat that I was reading the other day. It was like the last 40, 50 years, whenever there's been a rate cut and there wasn't a recession, the markets have ended up 100% of the time positive. And positive real numbers, like 15, 16%. When the Fed cuts
well, I like that.
Oh, I know,
sounds
right?
Good for us.
And no one talks about that because I don't know about you, but I think our economy's in a good shape, and I don't see a real reason to believe a recession unless you think the trade war is really going to blow up, which no one really believes right now. We're looking at a wonderful situation. So honestly, for the first time in a while, we're like, this is a risk-on situation. So how do you take advantage of some of the statistics that are in the past? We think, and though this might not be the sexiest thing to say, buying into small cap stocks right now, buying into things that take on a lot more risk than the overall market, and when things pop the right way, pay out a lot more. So I know it's not the same as talking about some of the other stocks like Chipotle and things that are going on right now, but getting into an area that I believe are way underserved in most clients' portfolios and load up in an area that has the highest probability of success right now.
So if you take that news that
Yes.
you've looked at, right, these stats over the last several decades, so if you have this cut, which basically is a gift, right, if in your eyes, because you think that the economy is doing pretty great, that will just give a nice jolt to certain particular companies, such as these small caps, which also don't really have the exposure to whole China trade stuff, right? So they're less. But you said that it's going to be a positive for small caps and government debt, but negative for insurance. So can you talk about the government debt and then the insurers?
Well, I mean, government debt, that one's easy. No one talks about it, but we've got a huge deficit right now, and it's only getting bigger and bigger, and both sides of the aisle have basically said we're not willing to address it. So there's not much we can do about that right now. But insurance companies...
We just got the okay on the debt ceiling. Basically, they're moving that
without
forward.
anyone saying, hey, maybe we should try to address it. But, I mean, we're in the Goldilocks situation right now with the economy doing very well, rates really, really low, and yet we can't work down our debt. I mean, we're in a situation where that's going to build. What happens when things go sideways? But that said...
Well, get to Prudential and MetLife.
Yeah,
Let's talk about some things that are on the move here.
Yeah, insurance companies. Insurance companies fundamentally is the one sector that we are really running away from right now. They've been riding out this ultra low interest rate wave for the last 10 years. They have a lot of regulation on them and a lot of restrictions on what they can do with their cash. So they charge their premiums. They got that cash sitting there. They can only do limited things on there with it right now. We were finally looking like they were going to get on the other side. It finally looked like rates were going to move on them. And now, 12 months later, rates have dropped on them. And foreseeable future, it's going to go down. There's probably another rate cut coming behind this. So I think that's one sector that is in real trouble right now, serious trouble. And in the next coming 5-10 years, probably are going to have major changes internally in order to get around this. Without a big rate hike coming, which isn't coming, this is the one sector that I would avoid more than any other.
Yeah, and Travelers has been the loser today as well.
All of them.
How about, you have other names such as Boeing and AT&T in your sites. Why?
Yeah, I mean, that's the more traditional route. We like companies that, frankly, are making money, that are going to continue to make money, that have heavy debt loads, that are going to take advantage of the lower interest rate environment moving forward, and that if we are wrong, and if there is a recession and things pull back, are stable companies that, I don't want to say recession-proof, but are able to ride it out. They're a type of portfolio building stocks that anyone should have in their mix that can get them through any cycle. That's not really as much of a risk-on premium. You're not buying a risk-on with AT&T, but you're buying a nice dividend in a company that can, you know, take advantage of lower rates. Value stocks are going to be more of a play here in the next couple of years, or in the next couple of months.
Oh, such as?
Well, we haven't talked about it in a long time. It's been probably 5 years since we've been talking about Amazons and all the fun ones like that. You got to start looking at the value side. Even, and this is a reach, but Apple is technically a value stock right now. Now, who in their right mind thinks Apple's a value stock? But if you look at the fundamentals and their cash and where they're at, technically speaking, they are value oriented. So the Netflixes, the Snaps of the world, like you were just talking about, they worry me. Whenever you're looking at a company that can't make profits in this environment, scares me. I know Snap has done very well this year, but I don't know if that's something that can continue long term. without a big turnaround from profit standpoint, real profits.
Right. So now it's time to look for some value and small caps.
Get after the small caps.
And some names we know that can benefit from these low rates, basically, right?
We're in a risk.
Last thought, Stephen?
Risk-on environment. Take advantage of it. And don't do it in your traditional routes. I've been a tech guy for a long time, love tech. Look outside the box to get your risk on in this environment.
All right, put on your hat to get really aggressive. All right, Stephen Dudash, President of IHT Wealth Management.